Welcome to the Financial Quarterback with your host, Jim Lineweaver.
I'm Jim Lineweaver, your financial quarterback since 1993. Over the last couple of years, interest rates have remained low to help boost the economy during the pandemic. But with the Federal Reserve indicating that they may increase rates 3 times this year, and some forecasters expecting even more than that, it's important to consider some strategies that may be beneficial as interest rates rise. So here to help me discuss a few of these strategies is one of our portfolio managers and chartered financial analyst, Travis Dragan. So Travis, where do we get started?
Well, let's start with why rising interest rates are generally a headwind for traditional fixed income. Bond prices tend to move inverse to the movement in interest rates, which means that as interest rates rise, bond prices may decline.
But these are strategies to better position investment portfolios for a rising rate environment, which includes implementing a bond ladder, maybe focusing on short-term maturities, and introducing income-focused alternatives. So let's talk about each one of these.
Right, so a bond ladder staggers bond maturities in the same way that a ladder has steps. So for example, we can construct a bond ladder that has maturities every 6 months out to 5 years in maturity. And the advantage of this strategy is as those shorter term maturities roll off, we can then reinvest at higher prevailing interest rates as these interest rates rise.
It's also remember that not all bonds are created equally, and they can be impacted differently by these changing interest rate environments. So longer term bonds are much more negatively impacted than shorter term bonds when interest rates rise.
That's exactly right, and that's why we recommend investors focus investment portfolios on those shorter term maturities rather than longer term maturities during a rising rate environment. Because these longer term bonds can lock investors into these record low interest rates for 20 or even 30 years.
However, focusing on short-term bonds may provide a lower interest rate and therefore decrease your income in retirement. So it's important to consider adding complementary income strategies. So what are some of the income strategies that people can utilize to help boost their retirement income?
Sure, so there's some really good opportunities to substitute in these income-focused alternatives such as private credit and private real estate. And also dividend-focused equity strategies can provide some great current income with the potential for that income to increase over time as the underlying companies increase those dividends. But either of these strategies can provide higher current income and the ability to diversify away from purely that traditional fixed income.
And having someone help you that has been through previous rising rate cycles and understands the market can help take the emotions out of it. Fear-based reactions or strategy changes can cost you in the long run, and having an experienced financial advisor in your corner can help you feel more comfortable with your choices and your strategies.
That's right, and it's important to stay diversified.
And that's always important. And thanks for joining us, Travis, to help explain strategies during a rising interest rate environment. If you're concerned about rising interest rates and want to learn more, or just have a question about your portfolio or retirement, we're here to help. Give us a call. Here's Fox News Sunday.